Hello and welcome to my YouTube channel. I'm Safir Ahmed, a senior lecturer in accounting and finance at a UK university, and I also work with ACCA as an early career ambassador. So this video is going to be relevant for ACCA F7 financial reporting student, ACCA F3 financial accounting students, also financial reporting in CIMA, and AAT Level 4 drafting and interpreting financial statements. It is also relevant for undergraduate accounting and finance degree students if they are studying financial reporting or financial accounting. It is also relevant for the non-accounting students for courses such as MBA, MSc International Business, or MSc Management, because as part of your accounting and finance unit, you normally study this cash flow statement. So often students get confused with this topic, and I thought that it will be a good idea to share with you a step-by-step approach how to prepare a statement of cash flow. So what's really important to understand that what is the difference between an income statement or a statement of comprehensive income, or also known as statement of profit or loss, and cash flow statement. So there are some similarities between these two, and the biggest similarity is that these both financial statements, they determine the financial performance of a company over 12 months. So one is like in terms of cash. So in other words, the cash performance of the company. The other one is profit performance of the company, in other words. And profit and cash, these two things are not same. Why is that? Because remember, when we prepare income statement, we use accruals concept. And what the accruals concept says that we are going to record expenses incurred and incomes earned. So rather than money is paid and received. So therefore, we have included expenses which are non-cash expenses, such as depreciation, when we have prepared the income statement or statement of comprehensive income. Similarly, we have recorded sales income, which we have not received it yet, but we have earned it. So therefore, the profit figure we have is not going to be the same as our cash in the bank, in the business bank account. So the key difference is when we prepare cash flow statement, we are going to look at the cash perspective, just cash transactions. No credit transactions we are going to record it here. So everything we are looking at cash perspective, because what we want to determine that over this 12 months, how much cash the business has generated, if the final result will be positive, and how in other words, that the business might have just spent more than they generated the cash. So in that case, it will be negative cash flow. So in other words, that the business must have used the overdraft in that case. Okay, so the key difference between the statement of comprehensive income or income statement and cash flow statement is income statement is based on accruals concept mainly. Obviously, there are other concepts that we use as well, but that's the main one. That's the underlying assumption as well when we prepare income statement or statement of comprehensive income. And when we prepare the cash flow statement, we need to kind of forget about accruals concept, and we will be looking at the cash perspective of the transaction. Okay, so I just developed a step-by-step approach, and also just to mention, there are two methods of cash flow statement preparation. One is direct method and the other one is indirect method. Now, direct method is a lot easier. So therefore, I'm not going to cover that today. But if you will have any question about that, you can always ask me. But what I will be covering here today is the indirect method, which is a bit more complicated as compared to direct method. And 99% chances are that this will be tested, whichever qualification you are studying. But again, you never know, exam is exam. But this is where students normally get confused as well. The direct method, normally students get on with that easily. Okay. So first of all, as usual, you need to write down the name of the company and then the statement that you are preparing. So of course, you are preparing statement of cash flows and for the year ended, whatever the year end will be in a question. And also it's worth noticing that this pro forma, I have used it or I have taken it from the IAS 7, which is International Accounting Standard 7, that deals with the statement of cash flows. So step-by-step approach, and I will be showing you the pro forma on the side. So you start with the profit before tax. Now this profit before tax, you will take it from this statement of comprehensive income. So that's why on the left column, I have written the way you will find this information in a question as well. So you start with the profit before tax, and then you make adjustments. And now you might be wondering why we are starting here profit before tax. Now remember that the tax we pay in relation to this year, normally it is within 12 months, because remember the taxation rules are different from the financial reporting rules. So therefore, the tax you will be paying will be in relation to the last year during this year. So therefore, this year tax, we are not really paying it during this year. So therefore, we start with the profit before tax. And again, this is as per IAS 7 statement of cash flows. So what we do basically, we start with the profit before tax and we reconcile it with the cash. In other words, the profit we made, remember that we must have deducted some non-cash expenses, things like depreciation, things like provisions. So what we are doing here, that we are reversing it. So we are adding it back. So as you can see that's your second step. So the first step is start with profit before tax. And then the second step is you add back non-cash expenses. So in this case, I just given you a few examples there, but it can be more than that. So depreciation is one of the non-cash expenses. Remember, the company has not spent any money on that. What is depreciation? Depreciation is spreading the cost of an asset over its useful life. So therefore, therefore we'll be adding that. Similarly, provisions is just allowances. So we have not really spent any money on that. But remember, we deduct it as an expense in our income statement. So what we are doing is a non-cash expense, so we are adding it back as well. There could be also accruals or accrued expenses. So expenses which became due, but we have not paid them yet. In other words, outstanding expenses at the year end. So again, we have not paid them, so non-cash expense at the moment. So therefore, we will be adding it back as well. Amortization is another example of non-cash expense. So amortization, remember amortization, we amortize intangible assets. So things like maybe patents, things like development cost, for example, of a project. So we add that back as well. Another one which can be impairment loss, and remember that this is impairment loss which we cover, which is covered as part of IAS 36, impairment of assets. So how we calculate it is a different topic, but remember, if we had any impairment loss, we must have recorded it as part of the income statement. And therefore, what we will be doing now, we will be adding it back because it's a non-cash expense. Similarly, loss on sale of non-current asset or fixed asset. If you think about it, how we have created that loss. So we compare the net book value of the assets or the carrying amount of the assets with the disposal proceeds. Now, if you think about it, carrying amount is cost minus accumulated depreciation. Again, accumulated depreciation is an estimate, and we are comparing the carrying amount, which is cost minus accumulated depreciation, with the disposal value. So it's not really actual loss, if that makes sense. So loss on sale of non-current asset means that we received less money than our book value of the asset, carrying amount of the asset. So therefore, it's a non-cash expense as well. So therefore, we will be adding it back. We also add back finance costs, interest expense. And this is where students normally get confused that why we are adding this back, because we normally deduct it a little bit further down, interest paid. So why we are adding this back here? Well, as part of the IAS 7 pro forma that we must have to add it back, it might be the same amount which was the interest expense during the year or for the year, and we have paid all of it, or it could be different as well. So therefore, the standard requires us to add this back as well. And remember, we started with the profit before tax. So we have not really, but we have actually deducted that finance cost there as well. So that's why. So we will be adding this back always, finance cost. So please make a note of that. Okay. So once we've done that, that was our second step, which is add back non-cash expenses. The next step is to deduct any non-operating or non-cash incomes. So non-operating income, for example, dividend income is our non-operating income. It's investing income, isn't it? So it's not operating income. So therefore, what we are doing is that we are deducting it from here, and we will be adding it back under investing activities. In other words, that we are removing it from the incorrect place and we are putting it in the right place. We will be adding it in the right place. Another example of that non-operating income can be interest received. Again, interest received is investing income. So it should go under investment, investing activities. So therefore, again, we will be removing it from operating activities and we will be allocating it under investing activities. So that's another example of non-operating income. And then profit or gain on disposal of non-current asset. This is opposite to loss on sale of non-current asset. Yeah. So we might have made loss or we might have made gain. If we made gain, now, if you think about it, it's not the actual gain. It's not the money gain. So therefore, what we will be doing, we will be removing it from here because we haven't received that money. Okay. We receive the actual sale proceeds in relation to sale of an asset, and we will be recording that under investing activities as cash inflow. But here, we need to deduct it because this is not the actual profit or actual gain. Okay, so that's our third step here, the deduct non-operating non-cash incomes. We've done that. And then what we need to do, we need to record the working capital changes. And now working capital changes will be increase or decrease in inventories, increase or decrease in trade receivables, increase or decrease in trade payables. So that will be our working capital changes. So whether we will be adding it or deducting it depends on whether there is an increase or decrease. Okay, so let's have a look. So if it will be increase in inventories, that means that we must have bought the inventories and we must have spent the money. So cash outflow, if it is increase, and if it is decrease in inventories, it means that we must have sold the inventories and we must have received the money, which is cash inflow. So as you can see, increase in inventories, cash outflow, and decrease in inventories, cash inflow. Similarly, if there is a decrease in trade receivables, which means that people owe us less money now. So what would have happened? They must have paid us during the year. That's why that they owe us less. So decrease in trade receivable will be cash inflow. Increase in trade receivable will be cash outflow. How? Because the company has given more credit to the customers. Now, any decrease in trade payables, which means that we must have paid, or the company must have paid to its suppliers. And if that's the case, then cash outflow, we must have paid. So decrease in payables will be cash outflow. An increase in payables means that we are given credit from our suppliers, which is positive cash flow. In other words, a cash inflow. Okay, so please make sure that you understand this bit really well. That's where students normally get confused in exam as part of a question. So you need to be absolutely clear on that. I can tell you a trick as well, but that's not ideal to remember. So increase or decrease in inventories, cash inflow and outflow is exactly the same for the increase or decrease in trade receivables as well. So if you can remember one of them, you will remember the second one because you know that it's the same. And then once you remember this, the payables one will be opposite to that. Not ideal, but maybe a backup plan. So you should understand the why, this increase or decrease, why cash inflow or outflow. But it does help that if you don't remember in exam, that if you just remember that, if you can remember one of them and then the other one, the receivables will be same and payables will be opposite to the inventories. So if you can remember the inventories one. Okay, so that will give you cash generated from operations. And then is the next step, which is step number 5, that you will be deducting tax paid and interest paid. Okay. Now, tax paid, you might have to do working for that. Interest paid is going to be straightforward. They will tell you how much interest is paid, or if they don't tell you, we will assume that the total finance cost, total interest expense, all of that was paid during the year. Okay, so once you deduct that, this gives you the cash generated or used from operating activities. So this is the end product of the operating activities. Okay. So in other words, that this shows you that how much cash we have generated, and you can kind of compare it with your profit as well, that you will see there will be a difference. And why? Because of those non-cash items and because of those non-operating items as well. Okay, this is also known as actually reconciliation of, I'm just going to write it here. So this is also known as reconciliation of profit to cash. So from your income statement to cash, basically. Okay, now let me show you the tax paid working one. How do we work that out? Okay, so you always start with the tax charge for the year. And what you do is that you add back decrease in tax liabilities. Because remember that we are trying to determine how much tax was paid. So if there was any decrease in tax liabilities, that means that we must have paid some in relation to last year's. Excuse me. Okay. So if there will be any decrease in tax liabilities, remember they will be given, they will provide you two years statement of financial position. So you will be checking the tax liability, whether it has changed, whether it has increased or decreased. So if there is a decrease in tax liability, you will be adding it back. If there is increase in tax liability, you will be deducting. So it will be only one of them in a question, but I just wrote both, so you know whether you will be adding or deducting it. So this will give you the tax paid amount. Okay, so which you will of course deduct it from here. Okay, so we have covered the operating activities side of things. In a cash flow statement, remember that there are three types of activities: operating activities, investing activities, and financing activities. So let's move on to the investing activities. Now remember, interest received, the one you have deducted it from operating activities, you will be adding it back here. In other words, that writing it in the correct place. Similarly, dividend received, you have deducted from operating activities, so you will be writing it here in the correct place, which is investing activities. Purchase of property, plant, and equipment, non-current asset, that we will show that as part of the working. Sale proceeds of from sale of non-current asset. So this is normally that we calculate it in working as well. So let's call it working 2. So let me show you these 2 workings, how you're going to approach those workings. So this is your working 2 where you are determining the sale proceeds. Now, what they tend to do in a question, they give you the carrying amount. Carrying amount is, remember, also known as net book value, depending on which qualification you are studying. And what we do is, so remember this net book value or carrying amount, how it is calculated is cost minus accumulated depreciation. Okay, so they normally tell you that an asset has been sold, the cost of it was this much, accumulated depreciation this much, and this much profit or loss we have made on that. Okay, so if we made profit on that, we add profit on sale of non-current asset. But we might have made loss as well. So if we have made loss in that, then what we will be doing, we'll be deducting from here. So less loss on sale of non-current assets. So there will be only one of them. Either the company has made profit or loss on that, one of them, of course, and that will give you sale proceeds. So if profit, you will be adding it, which means that we must have received more than the carrying amount, more than the net book value, or we will be deducting the loss, which means that we must have received less money than the book value. So that's why we'll be deducting that. So that gives you sale proceeds. So that's your working 2. Yeah. So I adjusted here, but actually I have shown it here separately as well. That if it was loss, we'll be deducting it. Okay. So this is how you will work out the sale proceeds from a sale of a non-current asset. And of course, this is cash inflow. So we will be adding it back in your under your investing activities, cash receipts, in other words. And then the way you calculate the purchase of property, plant, and equipment, you start with the opening property, plant, and equipment. In other words, that this is the balance that which we have at the year end of last year. So remember, 2 years statement of financial position will be given to you. So this will be the last year amount of property, plant, and equipment. And what we do is the less depreciation charge. Now, depreciation charge is the depreciation for this year, current year. This is normally provided to you as part of the further information of the notes. We add any revaluation surplus happened during the year, because that will be a reason for increase in the assets, if that makes sense. Okay. And then what we do is that, of course, the asset we sold, so any net book value in relation to those assets, or in other words, carrying amount in relation to that asset, we will be deducting it. And whatever amount you get, you will deduct the closing property, plant, and equipment. And this will give you the purchase of non-current asset, purchase of property, plant, and equipment amount. So what the company has spent in buying those assets. Okay, so this is where students normally get confused. If you remember this, you won't go wrong. These are kind of maximum amounts that they normally give you there. But if they want to make it really complicated, and I'm talking about this is for ACCF 7. So if they give you the purchase of property, plant, and equipment themselves, but as a balancing figure, you might have to find out one of them. So for example, depreciation charge. So in that case, what you will be doing, opening plus revaluation surplus minus this, and of course that this one you will be plus, and then minus closing will give you depreciation amount. So you kind of rearrange this calculation in that sense. But that's if they really want to make difficult. At AAT level 4, they don't normally test you that. University undergraduate degree programs, probably they're not going to test that as well. But the ACCF 7 financial reporting, that can come up. Okay, so these amounts, as part of your investing activities, as you can see, purchase of property, plant, and equipment, which I just showed you as part of working 3, and then sale of non-current, sale proceeds from sale of non-current asset. So that's cash inflow because we received the money, and purchase of property, plant, and equipment, cash outflow because we spent the money. And this gives you net cash generated or used in investing activities. So generated if positive and used if it is negative amount. And then the financing activities. So this is in relation to the capital structure of the company. So how the company has been financed. So remember, there are two major sources of finance. Okay, so two major sources of finance. One of them is debt, and then the other one is, of course, equity. So increase in loan or repayment of loan. So if the loan has increased, cash inflow, we must have taken more money. Repayment of loan, cash outflow, which means that we must have paid the money during the year, so cash outflow. Issue of shares, so if the new shares are issued during the year, cash inflow, because company must have received money from those investors. And redemption of shares, that the company bought back their own shares, so that's cash outflow. Now, dividend paid can be deducted either from here or from operating activities. To me, I normally think that it should be under financing activities. But yeah, because it's from the profits, so standard allow us either deduct this from operating activities or deduct this from financing activities. So this will basically give you net cash generated and used in financing activities. So if I go back to the step-by-step approach, so remember we recorded the investing activities, working for purchase of property, plant, and equipment, and disposal proceeds. And then we recorded the financing activities. So it could be the working for issue of shares. So maybe in order to calculate issue of shares, you might have to do a calculation, which is, let me show you here. So as you can see, share capital and share premium of current year, and then less share capital plus share premium of last year. It will give you issue of shares if positive amount, if it is negative amount. So that will be redemption of shares. Yeah, if it is negative amount. So if you look at that, so we have done majority of the steps. Now we need to calculate the net flow for the net cash flow for the year. So how you do that is those end product of each activities, you just add those three together. The net cash generated during the year will be basically, if I write here, net cash from operating activities plus net cash from investing. So again, if either of those amounts will be negative, you will be deducting it, in other words. So plus minus, remember the math rule. And then of course, plus net cash from financing activities. So this gives you basically net cash generated or used during the year. And what you do is you add cash and cash equivalent at the beginning of the year. So this amount you will be finding it from the statement of financial position of the last year. So whatever the amount the company has as cash and cash equivalent under under current assets. If it will be negative, then remember that you will find it under bank overdraft under current liabilities. So net cash generated or used during the year plus cash and cash equivalent, well, minus if it is bank overdraft, it will give you cash and cash equivalents at the end of the year. So if it is positive figure, this will match with your cash and cash equivalent for this year balance sheet amount for the cash and cash equivalent. If it is negative, that means that it must be bank overdraft for this year. It should match. So you should verify with your balance sheet amount if you've done everything correctly. Okay, So the direct method, just to show you quickly, the only difference from direct method is that your cash from operating activities will be calculated differently. Investing and financing remain the same. So as you can see, cash received from customer, cash received from any other operating activities, and then payment to suppliers, payment to employees, that gives you the net cash from operating activities. So only this portion, which is the operating activities, will be different in a direct method. Otherwise, everything else is going to be same. So in other words, what I was saying was like in direct method, you won't be doing all of this. Instead, what you will be doing, you will be calculating directly cash received from customers, cash received from any other operating activities, and then cash paid to suppliers and employees. So it's quite straightforward. And this is why majority of the time in exam, you see indirect method is tested rather than direct method. Okay, so I hope that you found this useful step-by-step approach, and you can apply this in different questions and give me any feedback if any question you will have as well. So I will make a video in future, kind of, including a comprehensive question. So where I will be showing you each and everything, all of these calculations, in other words. Okay, so thank you very much for listening. I will be back with another video. Bye for now.